You came here for the truth. On today's episode, we are going to get into the US consumer. 70% of the economy relying on the US consumer, and right now, it's not looking good. The second thing I want to cover is what's happening with inflation, but real inflation. I'm going to give you the data you need to know. And the third thing, we're going to look at the markets. ETFs are absolutely rocketing higher in terms of inflows. And I'm going to show you some other information that you will not find anywhere else. Stay tuned. Let's go. Another day, another Fed repo. The reverse repo operations have accelerated, and you could see that it is now sustaining itself over $1 trillion. This continues on and on. Speaking of the Federal Reserve, you can see this Bloomberg article, a $9 trillion binge turns central banks into the market's biggest whales. And that's a frightening fact. Okay, you could see their combined assets being $24 trillion. That's the Fed, the ECB, and the Bank of Japan. That's not even all of them. That is just a few, all right? And you could look at this, pretty interesting. I think everybody should do this. Go over to the Bloomberg article. Link will be in the description as always. And essentially what we're looking at is some of the biggest companies in the world and comparing that to the balance sheets of these three, the big three. And look, I could put Apple in here, $2.24 trillion market cap, and it's just a small fraction. You put Tesla in there, you put Amazon in there, you put Walmart in there, whatever, Sony and Airbnb and all these other companies. Nothing compares. The central banks are taking over everything. And people need to realize the real reason why this is happening. It is truly unfortunate to see it this way. Now, the US consumer right now is just not doing well. And why is that? Because the stimulus is fading away. And of course, the consumer needs that stimulus. You will see the direct correlation between when things are good and when they're not, when we have a stimulus check that comes out, unemployment benefits, and so on. Consumer sentiment in the US plunges to its lowest since 2011. This is just showing you about concerns about what's happening from 2020 until now, outlook for the economy, the income, and so on. But let's be honest. You can see the direct correlation, as I've said over and over again. The more that they give people, the more things look better. But it's just a temporary solution. It's just a band-aid or a bandage on top of a real problem. Here is the actual data, and you could notice, it might not be visible to you, but this right down here, 70.2, is just a small line in comparison to what we've seen over the last while. Now, if I back it up 5 years, you could see that we haven't been at this level since the beginning, of 2020 when everything fell to the floor. What does that tell you? Well, of course, you've got prices that are rising on everything, and I'll show you in just a second. And you've got people that are really uncertain about the future. Let's go back 10 years. Do we have this? Right. Back in 2011, we were at these levels, but we haven't seen anything like this right now. It's crazy. And this is just showing you the consumer sentiment, current economic conditions, and consumer expectations all have declined. It's actually gotten worse. So that should tell you something. This is the bad buying conditions for houses, durable goods, and vehicles. Everything is, of course, escalating. Why? Because the prices are astronomical. And funny thing is, we've got historically low interest rates. Should be helping people. Stunning deterioration. Consumer sentiment in the US plunges on concerns. You got the economic prospects as well. People don't know what the future has in store. That's what this chart says. This is the lowest since 2011. Sticker shock. Buying conditions deteriorate sharply for American consumers as prices soar. You know this. It's, as they're saying here, it's crazy. The lowest since the early 1980s. It's a good time to buy. Everybody knows this is technically not a good time to buy, but they feel the need to get in today specifically because I don't want to miss out. I want to be included, and so on. Number one, let's face it, the US economy relies heavily on the consumer. Without it, it's in big trouble. Number two, sentiment has dropped from the consumer as the stimulus has faded away. There is a direct correlation in between the two. I've shown you the charts many times before. Number three, investors pay very close attention to any bills that are coming now. You want to see those stimulus checks. You want to see the unemployment benefits and new programs that are created, because that's going to directly impact the prices of different stocks and, of course, impact the economy as well. Let's take a look at some of these indicators right here. They are off the charts. The Baltic Dry Index continues to move higher. It's at 35.66, and this is just unbelievable. If I pull it back on the 5-year, it's the highest we have seen through the period. If I pull this back, I mean, other than this massive spike throughout the period, 2006 leading into 2008, this is some of the highest we have ever seen. The chart goes back to 1985. So it's just an unusual time historically. Everything is so expensive. Global demand is not up that much. Maersk themselves has said global demand is at 2 points, at least, for them, their perspective, and it is a very good one at that, 2.7%. And yet the prices, just don't correspond. Now, looking at what Peter Schiff had to say, I thought it was interesting, and that leads into the data I'll show you in just a second. Export prices rose 1.3% in July. Year over year, they're up 17.2%. The 2021 gain is 13.5%, which annualizes to a shocking 23%. It's likely that prices of goods we don't export rose by a similar percentage. 23% is a more honest measure of inflation than the CPI. It's worse than the 1970s. What happened in the 1970s? Well, of course, you had inflationary pressures. There's no doubt about it. The stock market started to love that inflation, but later on, it took a turn for the worse. Inflation helped it at the beginning and then turned on it in the end. This chart right here is just showing you the green is the import price index. Okay, and the export price is the red. And while you see the import price declining slightly, it has still moved up, no doubt about that. But I'll cover this more as we see the trend, because whenever there's sort of a blip, I don't like to think that that is necessarily a major indicator of a turnover, because sometimes that just turns around really fast. So I'll keep you up to date. Look at the import price index for China. That has accelerated as well, going back to levels we haven't seen since approximately 2016. So we'll see if it continues, as it seems like it will. Looking at this chart right here, I'll just highlight it because I know the font is a little bit small. You're seeing the imports, and this comes directly from the BLS, by the way. Imports here, exports here. This is the month, and you could see these two down here just showing us July 2019 to 2020, and then July 2020 to 21. And you could see the major differences, okay? Looking at July 20 to 21, this is the all imports, 10.2%. So this is the percentage change in import and export price indexes, okay? 10.2%. Fuel imports, 66.5%. Non-fuel imports, 6.3%. In terms of exports, agricultural exports 29.2 and non-agriculture 15.8. So just to give you a little breakdown of exactly what's happening, people need to realize that the prices are absolutely berserk. Look at this, import prices. You can see the chart for yourself. It's self-explanatory. Things are rising higher and higher. Now, there are supply chain problems. There are problems going on just about all across the board. You've got problems with truckers. You've got the problems with the trains. You've got the problems with the air freight, all kinds. But at the same time, underlying all of that is the central bank activity messing everything up along the way. That's what we're not supposed to talk about for whatever reason. As crude oil breaks below $69, traders reveal their outlook for energy's next move. You're seeing this falling right now, and what they believe right here on top of this, the IEA also lowered its forecast for the demand in oil for the rest of the year. Why? Because the potential for lockdowns. Lockdowns are obviously going to present themselves right now. Huge problem. There's no doubt about it. Will we get there? Who knows? Areas like Australia and others are definitely feeling it with the lockdowns today. It depends on where they are, of course. Overheated real estate market begins to cool. You see that one article, you read the title, and then of course the information within it is not exactly the case. But they do say that there's a lot of buyer sticker shock, and people are a little more investment oriented. They already own a home, they've pulled back, and so on. Basically, just saying that it's slower. That's what I want to tell you right now. There has been no correction. There has been no crash. It's just slower. Now, if we move into September, we get September's data and it's still slow, it's still getting slow, then there's something fundamentally wrong. But usually around this time frame, things are slower. Home prices in the world's most expensive market break record, Hong Kong. It actually broke beyond the level from 2 years ago. Hong Kong, one of those places. I saw a parking spot selling for $1.3 million in Hong Kong. $1.3 million equivalent. Insane. What kind of car do you park in a spot that's worth $1.3 million? Wow. This is the 3-month LIBOR rate. And I just wanted to show you this. It's something that I don't show often, but I mean, it's just going lower and lower and lower and lower. And in fact, traders are betting that the LIBOR will go into the negative. It is at 0.12. We're basically there. So we'll see what happens with this over time. Now, I wanted to show you this. It's just something. I think it's interesting. I've talked about it before. This is called the Hindenburg Omen. It's one of a million different indicators. But essentially what we're looking at here is, number one, on the NASDAQ, that's the blue shaded area. And the red is the Hindenburg Omen's 6-month total. So it gives us a little breakdown. This goes all the way back from 2014 up until the present. And the more times this triggers in the period, then it would go higher up on the chart, which right now is at 10. So you're seeing the Hindenburg Omen in the last 6 months trigger 10 times. There's a breakdown. It's kind of complicated, but it does have a fairly accurate determination for corrections. This right now is at a historically, fairly high number. There's been a few cases over the past where it has, been higher, but essentially 2020 was one of those cases because, of course, leading into 2020, everything was getting crazy. 2018 markets came down throughout the period, and in this case here, false positive, right? 2017, it was supposed to be this way. Things declined as we moved into January of 2018 and so on. So it's not perfect, definitely, but right now that's what has happened. These are two things. Check this out, okay? Stay with me on this. Two things right now, and they kind of contradict each other, but look at this. Out of Bloomberg, inflation-protected bond ETFs post a record inflow. Okay, hold that thought. Traders pile into tail risk bets that the Fed won't hike at all. Open interest on tail risk hedge has jumped 700%. Traders also purchasing options that target negative LIBOR. So what's happening right now is that money is just moving anywhere and everywhere. That's the way I see it, except for gold and silver. Okay, gold and silver aren't feeling any love. What is feeling love, though, is this. Global ETF assets hit $9 trillion. Nothing like this ever seen before. Record amounts of money are coming into the ETFs because why? People are tired of paying for those very high percentages to their mutual funds, which have not been able to beat the market. So people are putting their money in, they trade it easily, it is accessible, and all these companies are creating new types of ETFs. An ETF of everything. If you want to get into bonds, no, you don't have to buy bonds. You buy an ETF. You don't want to buy the futures of something, you can buy an ETF of that. You want to have leverage, which is what a lot of people are doing today. Leveraged ETF, 2x, 3x, who knows, 10x, I don't know. There's all kinds out there. This just gives you the chart. It is truly excessive. Now, of course, remember, in the previous crisis, ETFs were in their infancy practically, okay, in terms of the amount of money really in there, truly. Things are going to be different next time around. Really quickly, two more things. Evergrande fears sends stress in China's bond market to new high. We're talking about perhaps the biggest developer in China. It's going under. The way I look at it, it's already under. This is a company that China has to take over or has taken over, and they will obviously, as they're sending here, it's kind of sending shockwaves through the system. They're covering it up. We don't know what's going to happen in the end. But of course, just like this case here, which is also out of Bloomberg, Bill Huang with Archegos, all of these things go largely unnoticed to the average, the retail, the typical investor. But you as an individual, you need to be more astute and figure this out. You need to manage your money properly. You need to do things that are more appropriate. Have prudence when you're investing. If you want to put your money into the market, think about swing trading versus now's the time I'm going to put my whole paycheck in this stock or that stock, or I'm going to wait for a short squeeze so that I can see mine go to the moon. This is not the time for taking excessive risk. Doesn't necessarily mean you sell everything, but watch out and watch very carefully. For anybody interested in what's happening with Archegos and Bill Huang, this article right here talks about it. I would recommend taking a look. This right here is just the insiders. If you haven't got on it already, I don't know what you're waiting for. 5 times a week, I email you the video of the day. It gets right to your inbox. No spam, no garbage, none of that. I just want to be able to communicate to you directly because quite frankly, they're trying to prevent that. And I want to get you on. It's available at this card up here or go to themoneygps.com. Smash that like button. I appreciate it very much. If you haven't seen this video already, you want to check it out. It's got some great detail in it. Click it and I'll see you there.